want an exposure to a market or an
Everything they need in one place.
Being the world's foremost authority on individuals, advisors and institutions.
Hello and welcome to Morningstar. I'm Emma Wall, and here with me today to give his 3 UK stock picks is Chris Kinder, manager of the Threadneedle UK Absolute Alpha Fund. Hello Chris.
Hi.
So what's your first stock?
I think the first stock that I'd like to talk about is Wood Group, which is a sort of FTSE 250 oil services company headquartered in Scotland. Interestingly, they've just had results today, so it's quite topical for the viewers. I think it's a really interesting time to get into to have a look at the stock. Primarily, again, valuation very important to us. It's on 12 times earnings. I don't think the earnings are at a peak. In many ways, they are suffering a little bit at the hands of the oil majors who are cutting back their expenditure. But actually, what you see with Wood Group is very strong profitability improvement in certain geographical regions, particularly in the north of America, where they've got a fantastic shale business they've been developing. And also, I think in the next year or so, we should start to see a recovery in some of the bigger projects in deep water, where they've got a great market position. The business model is very sound. They allocate capital incredibly well. And as I say, fundamentally, the stock has significant valuation attractions.
I think there's two red flags there. Number one, the oil and gas companies, commodity companies in general, have not done very well over the last couple of years. And also, secondly, that it's based in Scotland. I mean, we've got the yes or no vote coming up next month. How much are those two things a concern?
Yeah, I think first and foremost, when I say based in Scotland, it is where the corporate HQ is. The vast majority of the activity is clearly in North America. They're global. They've got business in Australia, in Africa, all around the world. Funnily enough, they do have quite a big exposure in the North Sea. And clearly, we don't know the result of the referendum. You wouldn't ask me to predict that. But I think one thing that is happening, though, is that there is a real will to revitalise North Sea production, which has been coming down now for a number of years. And Wood Group, with their strong position up there, should be a beneficiary of that, actually. And I think strangely, that business is performing quite well for them and actually could do even better than it is currently. So I'm not so worried about that. There's always been this thing in the market about the oil majors suffer because they pay too much to the service companies, of which Wood is clearly a beneficiary. I think the truth is the oil majors they'll cut back on capex at the margin, but the new fields are becoming they're increasingly more complex to access. A lot of them have taken out that in-house expertise themselves.
They need these innovators.
They need these people. Wood Group don't charge too much. They charge a fair value for their services. So at the margin, that's why it is a pressure, but I think it comes through, and I think most importantly, it's reflected in the price.
What's your second stock today then?
Another one that is sort of under a bit of pressure at the moment is Rolls-Royce, which has been a long-term favourite of mine and my company's. And first and foremost, as you probably know, it's a number 2 in a global duopoly on aircraft engines, has a marvellous business model whereby the engine goes on the wing, they don't make much money up front, but then the engine generates revenue for the next 25 years. That aeroplane stays in the air, and that revenue is the aftermarket revenue, which is very high margin. So it's a great long-term business model. At the moment, they are struggling as they build new facilities, and they're putting the cost in to facilitate the production of the next generation of engines. And that's why the profitability is a little bit depressed at the moment. But as these engines get up in the air, I can see really, really strong cash flow coming through from that business. And again, the valuation is quite compelling at this point.
How much are these aviation companies affected by fuel duty and etc.? Is it just the service airlines that get hit by these, or do the manufacturers do it as well?
Yeah, I mean, the airline, interestingly, I would differentiate my investment view between the airlines and the equipment suppliers. Personally, I wouldn't invest in airline companies. Those are the people who have to wear the fuel bills. Recently, they've been able to put prices up to compensate for themselves for that, but they'll have a far more volatile income stream, and that obviously is a risk to Rolls-Royce, of whom they are the end customer ultimately. But I think, an interesting dynamic is what we're seeing in the market is that the order book of Rolls-Royce is predicated on new planes, which are far more fuel efficient, as these airlines really try and get their fuel bills down over time. So strangely, the high fuel is sort of counterintuitively quite a positive impact for Rolls-Royce.
And what's then your third and final stock?
Again, another stock quite topical at the moment is Persimmon, where we've had a holding now for a number of years. It's performed extremely well, so one is always quite uncomfortable recommending a share that's gone up a lot, as we talked about earlier. But strangely, looking at the outlook for the company, it's amazingly strong. What people, I think, perhaps have failed to appreciate is how much land these guys have and how at the prices at which it's been bought, which basically guarantees very high future margins and very high future returns on capital. And because they have so much land, the need to buy more land is relatively limited, which means the cash in the business can be returned to shareholders. So Persimmon are really leading the way in getting the money back to shareholders.
Persimmon have been hugely boosted by low interest rates and these help to buy schemes from the government. But even the government themselves, and certainly the Bank of England, are almost, turning their back on their own plans because they're raising red flags about the housing bubble.
Yeah.
I mean, if this implodes, surely that means stocks like Persimmon will implode.
Oh yeah. Hey, look, if you were to tell me factually that house prices were to fall 10% compound next 3 years, I don't think you'd own Persimmon. And I think I love the sort of the rhetoric of a bubble. For those of us sitting here in London, I think we see it every day. But if you go out into the regions, you will see house prices not having moved for 7 or 8 years now. And obviously the house builders, certainly Persimmon, have far bigger exposure in the regions than they do in the UK, than they do in London. So I would really differentiate between the London-focused house builders, who I think are going to find it really hard to put prices up, and those in the regions where prices should, match inflation, a couple of percent. But the key is the land and the margins and the cash.
Chris, thank you very much.
It's a pleasure. Thank you.
This is Emma Wall for Morningstar. Thank you for watching.